Hey everyone, and welcome to the author interview series. Today I have with us Andrew Hallam, who is a high school English teacher by profession, a self made millionaire, a teacher on personal finance, and the author of the books Millionaire Teacher and The Global Expatriate's Guide to Investing, both of which I really enjoyed. And Andrew, thank you for taking the time to be here today.
Thank you, Ryan.
Now, so you're an English teacher by profession. Now, how did you get into finance or personal finance? What is your story?
I think I probably started learning about personal finance before I started learning about how to become a school teacher, because it was probably my very first year of university where I was working a part-time job, and I met a guy who was a mechanic, who was a self-made millionaire, who really inspired me and said, if you become financially literate, you don't need a massive salary. You can end up building wealth, even on a middle-class income. So I started reading finance books, and by the time I was 35, I think I'd read about 30. No, what am I talking about? By the time I was 35, I think I'd read about 400 personal finance books and books on investing. And so I started writing about investing in my early 30s. So I was writing for Money Sense magazine. Then I started to write for Canadian Business Magazine, the Globe and Mail. And during that time, of course, I was teaching. So I had two careers running simultaneously. And then while I was at Singapore American School, I was eventually I ended up teaching both high school English and high school personal finance.
Wow, I didn't know that you could teach high school personal finance at in school, but that's amazing.
They should have that in every school.
Yeah, no, I agree 100%. That's a very tangible skill that everyone should learn.
Yeah. It's the only thing we all need to learn. So that's the funny thing. Like when I wrote the second edition of Millionaire Teacher, I started it, like the introduction talked about that guy boy in a band. His name is David Brown, and he wrote and he sang and uploaded onto YouTube a song called "Don't Stay in School." And have you seen it?
No, I haven't, but it sounds funny.
You've got to see it. It's really really good. He's essentially ranting about the education system, saying, "Look, here are all of the useless things I learned when I was in school, and then here are the things that I should have learned that we all need every single day, but we don't learn." And so one of those things was personal finance, how to disperse your earnings, how to buy a house, how to invest money. And he thought it was completely insane that we learn all kinds of stuff that may not be practically used and once we graduate. And I believe it. So I opened the Millionaire Teacher second edition with that story of that song.
Yeah, no, that's amazing. That's a very good point that you make out there, and it's good on you that you're trying to educate others on becoming, I guess, financially literate or financially independent. So that's amazing, and for yourself, you didn't actually major in finance? It was just kind of a side interest. Is that correct?
That's right. Yeah. So I guess I ended up reading many more books than I would if I'd taken a degree in finance. Maybe I wouldn't have been as inspired to continue learning if I had done. I'm sort of one of these guys who's more interested in doing something when I'm intrinsically motivated. If somebody says I have to read something, I'm not all that interested.
No worries. I think a lot of people can attest to that or can relate to that. But okay, so in your book, you talk about something called low cost index investing, i.e., somewhat the couch potato method. Now, for people who are new to investing, now where or how can they get started?
It depends on where they live. So if they live in Canada, one of the easiest ways to build a low cost portfolio, let's assume that you have no knowledge of all about finance. Is this what you want in terms of, is that the question you're asking me?
Yeah, yeah. So
Okay.
for anyone who's just trying to get started with finance or learn about low cost index funds, where or how can they get started? Where can they go for information or how can they get started? Like what are some first steps that people can take into
Well,
investing?
first, I think reading a little bit about it so you understand why you're doing what you're doing
Mm,
and why that's important. So I can say, all right, go off to Tangerine, which is what I started to talk about, and say Tangerine's a great company in Canada that will allow you to build. They'll build portfolios of index funds for you. They're fairly low cost. They rebalance the portfolios once a year. And if you use a firm like Tangerine, odds are high that you're going to outperform any financial advisors over long term that you have with RBC or TD or Bank of Montreal because the costs are significantly lower. That said, I come back to reading about it. So picking up some kind of book on investing or investing in mutual funds, because if you pick up any kind of book, what you'll see, or you read any kind of peer-reviewed study, is you'll see the same thing. The best odds of success with a portfolio of funds comes when you pick portfolios of low cost funds, not funds that have done well in the past, not funds that have a good 5 or 10 or 1 year track record. When you're going forward, the best statistical odds of success are going with the lowest cost funds of all, and the lowest cost funds happen to be index funds. And so to understand this premise, I think it's really important that people pick up, say, A Random Walk Down Wall Street, written by Burton Malkiel, or The Little Book of Common Sense Investing, written by John Bogle, or my book, Millionaire Teacher, because it explains all of these things. The Coffee House Investment by a guy named Bill Schultheis, Seattle-based financial advisor, is a really good book as well. But understanding the premise first, it's really simple to do, but you don't want to get knocked off the horse. You don't want someone to convince you not to do it. So this might sound kind of crazy, but if I'm speaking to people and I say, okay, this is what you really need to do, because all people want to be is often spoon-fed. Tell me what to buy. Tell me what to invest in. Well, I'll tell you what to invest in. Problem with that is there's no foundation. It is simple. It takes like 20 minutes a year. That's probably about all the amount of time I spend on my portfolio. I don't spend time looking at the stock market or having to think about it. 20 minutes a year is about all you need to do. You don't need any kind of special insight, and you can beat 90% of the pros. But if someone tries to convince you otherwise, and you don't have a rock solid foundation, you may end up deciding, I'm not going to have that portfolio of index funds. I'm going to sell it and go with these actively managed products through Royal Bank of Canada, which would be a huge mistake.
Mm. Yeah, so basically finding funds that are the lowest cost that I guess track an index, is that correct?
That's correct. Yeah.
Okay. And so for yourself, do you personally invest in anything else other than low cost index funds, maybe specialty funds, commodities, currencies? I mean, for yourself, do you invest in anything else?
I follow the KISS principle to keep it simple.
Okay.
And my entire portfolio is made up of a Canadian stock market index, global stock market exposure, and a Canadian bond market index, and that's it.
Okay.
My wife has something similar, but my wife's an American, so my wife essentially has a U.S. bond market index, a U.S. stock market index, and an international stock market index, and that's it. That's as simple as it is.
Okay,
We own,
so
we own a condominium, but we don't think of that as an investment. I always think of like a single home or one home is not an investment. It's your second property and your third property because eventually you always need to live somewhere. So
mm,
if you have one piece of real estate, it doesn't matter whether it's you're living somewhere else and it's being rented out and someone's paying for you in terms of the mortgage. It's not an investment. It's a second property, it's a third property, it's a fourth property. So those are investments. So it'd come back to that question, do I have real estate investments? No. Do I own a condo outright without a mortgage? Yes, but that's not an investment.
that's I love that answer. It's have you read Robert Kiyosaki's book Rich Dad Poor Dad?
I have, yeah.
Yeah, he just talks exactly what you said, and I'm a big believer of how any sort of assets that kind of where you have to pay out a monthly sort of cash outflow, that's technically not an asset that most people think of.
That's correct. Yeah, it's essentially you're buying shelter. It's a bit of a liability in a sense. So Robert Kiyosaki refers to that as a liability. I don't know if I'd go that far, but it's definitely not an asset. It's shelter.
Okay, yeah, I love it. And so there you have it. Invest in those three things: the your local equities market, your local bond market, and somewhat of a global market. Okay, so that I love it. It's very simple.
Very simple.
And so for yourself, there's many types of investors. Example, there's income investors, growth, value, etc. What would you say your investment style is?
Mine is it's a portfolio based on global market capitalization, plain vanilla index funds, very much the same as what Burton Malkiel would suggest. So Burt Malkiel is the author of A Random Walk Down Wall Street, which he was an economics professor at Stanford, I believe. And that book's in its 11th edition. But he says, keep it simple. And
Mm,
so there are loads of people who try to make things complicated. They'll look at what we call factor-based ETFs or factor-based index funds. They'll pick a value-based index, so it's an index filled with value stocks or an index filled with growth stocks. And one of the problems with that is, and one of the really fascinating things to me is when I see Morningstar produces data or Morningstar records data on how well specific funds have done and how well specific investors or how well on aggregate investors in those exact same funds have performed. So I'll give you an example. You can take the Vanguard S&P 500 index, and let's just say, for argument's sake, that it's averaged a compound annual return of 8% a year over the last 10 years. Okay, you would think that the investors who've been in that fund over the last 10 years, if they were rational, they would have earned an 8% return, right?
yeah.
So the fund earned eight after fees. You
Hmm.
think that the investors who were in that fund during that same 10-year time period would have earned 8% if they were rational. Unfortunately, most investors aren't rational, right? They like to buy more when it's had good runs. They like to buy less when it's had bad runs. And when you get into things like factor-based funds, like value funds, small cap funds, mid cap funds, and actively managed funds, there's a large disparity between how the fund performs and how the investor performs. And that's what's kind of crazy. It's like we have Neanderthal-like brains. We're horrible, and I find often the smarter the people, the worse the investor.
Uh,
So that's an interesting thing because they always try and often really smart people that they might have degrees in finance or really strong interest in economics, are often reading about who's predicting what. So what sector is predicted to do well, and then putting more money in that sector. So they might say, well, growth funds are going to do well, or growth stocks. So they'll buy more of that. Value stocks are going to do well, so they'll buy more of that. What they end up doing is they end up kind of sabotaging their own results. It's like kicking themselves in the groin, as if you. I mean, that seems like a kind of impossible kind of image, but that's what most investors do by chasing yesterday's winners. And so you find that behaviorally, the best investors are typically investors in target date funds. So I'll give you an example of that. You can have Vanguard, for example, in the United States, just like Tangerine does in Canada. They'll have a portfolio that is all in one. So it's one portfolio wrapped up into a single fund. And within that single fund, Tangerine has them. They cost about 1.07% a year in Canada. Within that, you have a Canadian stock index, a global stock index, and a Canadian bond market index. And most of the people that buy these funds, they don't know that much about investing. And they don't stick shift. They're just going with, well, these guys will do it for me. They'll rebalance it once a year. And so they end up dollar cost averaging into the fund every single month. But because they're, quote, know nothing investors, they don't speculate. And they typically tend to outperform the fund's performance itself. So that sounds kind of weird, but let me give you an example. So Morningstar rates, again, how well a fund does and how well the investors in each fund does by following cash flow. So the cash flow that goes into the funds and the cash flow that goes out. They can actually estimate how the average investor in each specific fund has performed. And so with those target date funds, Vanguard's target date funds, and I suspect with Tangerine's funds will be much the same, people are very much just automatically putting a set amount of money into their funds. They're not following the markets, they're not doing anything. But as a result of dollar cost averaging, they end up paying less than an average price. So let's say they're putting $100 a month in. As the unit prices rise, that $100 a month buys fewer and fewer units. As that unit price falls, their same $100 a month buys more and more units. As a result, they pay less than the average unit price for the actual fund. So with Vanguard's target retirement funds, if the average fund earned 8%, you'll find the average investor in those same funds earns about 9.
oh wow.
It's phenomenal. What you'll find is people that start to build their own portfolios and get a little fancy and trying to guess where things are actually going to go, excuse me, end up drastically underperforming the market and drastically underperforming their funds.
Wow, that's yeah, that there you have it. It's just like what Warren Buffett said. He says, Wall Street makes their money off of activity, whereas the investor makes their money off of inactivity.
That's correct.
So,
Yeah.
yeah, the Oracle of Omaha has just spoken. And okay, well, yeah, no, that's great. So for those of you who are listening, just don't think that you have to constantly be trading or you always have to be adjusting your portfolio because just as Andrew Hallam has said, that basically the less you touch it, the more money you'll make.
That's correct. We've got brokerage studies on that too, where the more trading you do, the less money that you make.
Hmm. Yeah, it's all those fees that just kind of add up.
Yeah, it's fees and it's chasing your own tail. It's
Hmm.
buying something that's gone that essentially buying high and selling low, and that's kind of the knee jerk reaction we end up falling for.
Yeah. So now you're a millionaire. I'm sure you were a millionaire before now, but when you saw that you hit that millionaire mark, how did it feel?
I didn't care.
Oh, really?
No, people have asked me that before. I didn't care, and I don't think you'll care either. It's it's uh it's nothing.
Okay, so it's just a number to you.
It's yeah. It doesn't mean anything. It's not like all of a sudden I can jump 6 feet higher and I can run 5 miles an hour faster. If those are things that be really cool.
Yeah.
Those are things that are really cool.
Okay, but so when you just saw that number, you're like, just another day.
Yeah, yeah. Just another day.
Okay, that's um, that wasn't exactly the answer I was expecting, but hey, who knows? I mean, for any of you out there, if you become a millionaire, please let me know, or please let Andrew Hallam know, and just say, hey, you know what, that was the best feeling, or But uh, so at any point in your life, did you know that you would become a millionaire?
I think by the time I was in my early 20s, I thought, yeah, definitely. By the time I would be in my 40s,
Mm,
I felt certain that I would be uh, that I'd have net assets of $1 million by the time I was in my early 40s. So I felt that when I was in my 20s, early 20s.
yeah, I mean, then again, you paid the price. In your book, you talk about how you would bike to work. How many miles was it, or how many kilometers was it?
Yes, it was 55 kilometers each way. And,
Yeah.
but yeah, I mean, I had done the math. I knew based on the amount of money that I was saving, based on the fact that my salary would only rise over time, and that I would be able to continue to invest more and more money. So I knew that that would be a virtual inevitability as long as the markets didn't do anything totally crazy. And if they did do something crazy, it just meant that I would be stupendously wealthy later on because of
Mm,
course, when the markets don't rise, it's kind of like catapult. Markets will rise in correlation with business earnings, when they
yes.
include dividends into that factor. And when they don't rise, and lately people have been really spoiled. I mean, since 2009, the markets have gone like 8 years in a row and just been rising, 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 or at least the US market has. Um, Business earnings on aggregate continue to rise. So every 2 or 3 years, business earnings will always hit new highs. Stock
Hmm.
market growth kind of goes up and down, but it continues to rise on aggregate. But when it doesn't rise, that's an awesome time. When it drops, that's awesome. Like I think of it as like a catapult, and you want that catapult to stay low, and the longer it stays low, the more stuff you pour onto that catapult. Once it launches, it absolutely launches. So I knew this too because I was reading so much about business and investing. I knew that, in my 20s when I first started, I started when I was 19. I knew by the time I was in my 20s that, wow, if the market doesn't rise for 5, 6, 7 years, this is the best gift I can ever be given. This would just be the gift from the gods because I could just continue to pour more and more money in, and then eventually when the markets do rise, it's just going to be like
Massive.
massive, yeah. And maybe at that point it would have been kind of cool to go, whoa, celebrate or something like that. Yeah, so I tell young people, I said, you know what? Ultimately, you can't predict where the markets are going to go. So don't even bother trying.
Hmm.
Don't be foolish and say, I'm not going to put money in because the markets have hit all-time highs. That's just plain dumb. Don't not invest because the markets are falling or they may fall further or they've fallen a lot because that's simply crazy. Just add money every month.
Yeah, no, I agree 100%. I mean, it depends on, I guess, what sort of life cycle you're on. I mean, if you are someone who's older, I'm assuming you would want them to appreciate, so then you can just kind of cash out. But if you're young, then yeah, like you said, you want those dips so you can purchase more shares or more. You can just purchase more with your money, and then
Mhm.
as the markets as they rise again, you're able to just see that massive growth.
Yeah, that's it. Warren Buffett says that anyone who is within or has at least 5 more years of working, those people should hope for stagnating markets or falling markets,
Mm.
not rising markets. But most people think rising markets are awesome.
Yeah. No,
It's
I
like
agree.
it's weird. It's hard to get that through to people, especially new investors. It's kind of like celebrating that the groceries in the supermarket are rising in price, and you having to continue to buy them. You don't really want them rising in price, and the market's much the same. You can't stop it from rising. Eventually, it always will. But gosh, it's so nice when you get a reprieve and you can just, if the markets go on sale, these are just fantastic, fantastic times.
Yeah, you better have that cash ready. Just kind of go shopping.
Yeah, and even when you say cash ready, it sort of implies that there's some kind of market timing associated with it, but there isn't. If you have a portfolio with bond allocation and the
Hmm.
stock markets drop and you're ready to rebalance at the end of the year, well, you end up selling bonds and buying stocks. And then, of course, like me, if you're like super greedy in 2008, 2009, even before that, like when we've had different market crashes, 2001, 2003, we had some good market crashes then. I was doing anything and everything I could to end up increasing my income. I mean, I was writing more for Money Sense magazine and I was doing more tutoring. I was doing more of anything I could to just pour money in. And it didn't matter if I put money in and it went lower the next month or the next year. I was even more excited by that because I realized, wow, I keep on doing this. It's going to be amazing.
Yeah, yeah, no, that's I love that contrarian mindset that you've got. Like you said, most people are just excited when it's a bull market, but I guess if you're young, you want it to be low so you can just
Oh,
go all in.
yeah. It's the same. Like, I mean, right now, I still have an income because I have income from my books, I have income from my writing. So I write a column for Asset Builder. It's a US based financial service company. I'm still writing for the Globe and Mail. So there's income. I'm not working regularly right now, but I still have income coming in. If my portfolio were cut in half tomorrow, I would be absolutely dancing in the streets, far more so than I would have been like hitting that first $1 million. I'd be freaking thrilled because I'm 47 years old. I'm not doing nothing. I'm not wandering around playing golf. I'm still earning an income, even though I'm traveling around the world and having a lot of fun with that too. So I kind of have right now the best of two or three worlds. But I'd be absolutely thrilled. I'd be dancing in the streets if my portfolio lost $1.5 million tomorrow. I'd be absolutely thrilled. Absolutely thrilled.
Wow. Oh,
But that's how you
okay.
have to think. That's how you have to think.
Wow.
And that's how we have to wire our thinking.
I love it. I love it. Just take away my money and you're thrilled.
It hasn't gone anywhere, though. That's the whole point. You still own those businesses.
That's true.
So the entities are still yours. You still own them. And those business entities, Coca-Cola, Walmart, ExxonMobil, Apple, Google, on aggregate, they still continue to make more money. So the intrinsic value of those companies will continue to rise year after year,
Hmm.
but they're selling at a discount. But you know what? I'm not a seller at this stage of my life. What am I? I'm a buyer.
Buyer. Yeah.
I'm a collector. So yeah, while I'm collecting these things, I want them cheap. Yeah, because I know the intrinsic value of those businesses is rising.
That's a great way to look at investing. I love it.
The
And
only way.
Now that you're financially free or somewhat financially independent, I would assume, what do you do with all your time?
Oh man, great question. Well, of course, as I mentioned, I don't do nothing. So I like to continue. Like today, I was working on a piece for the Globe and Mail,
Yes.
and it was a piece about retiring in Mexico. So uh, my mentor teacher, actually, when I was a student teacher, lives in Oliver, BC,
Okay.
and I met him for the first time last week, for the first time since I was his student teacher.
Wow.
And we started chatting, and he said, "You know what? I want to quit. I'm having a great. I've been teaching for a long time. I enjoy it. My wife and I have decided that we want to quit early. We won't end up getting our full pension, obviously, because he's 56, his wife is 51, so she won't even get any kind of teacher's pension until she's 55.
Hmm.
And so his colleagues were saying, "You're nuts. You're crazy. You don't want to be quitting. You're insane. You're giving up so much money." And he says, and his philosophy is kind of like mine. He says, "You know what? I'm giving up more if I continue working." Because
Oh.
he says the world is so big and there's so much I want to see and explore. And so he decided to retire in January, and he's telling me about this is kind of what my pension would be, and these are our assets. And he says, I'm thinking of going to spend, we're thinking of 4 or 5 months a year in low cost location like Bali or Mexico. And so I wrote a story about him for the Globe and Mail and did some research on it. And I've spent quite a bit of time down in Mexico where it's really cheap and some really, really cool spots. And so just put this piece together, which will probably publish next week for the Golden Mail. So I mean, these are the sorts of things I do like to do. Is continue to do stuff in terms of the writing and thinking and meeting new people. Right now, my wife and I are driving a camperized van down to Argentina. So we're talking right now from Colorado. So
Oh.
we
Yeah.
bought we
Yeah.
bought the van in Kamloops, British Columbia, and we've been weaving down sort of through the Okanagan into the U.S. We're in Colorado now. We're going to work our way down to the Baja Peninsula, head our way down southern into southern Mexico, and then eventually take that van all the way to the southern tip of Argentina, and then come back. But really take our time. So we'll be on the road for about 2 years. And there are a couple of speaking engagements along the way that I'll be doing. So we'll be parking the van somewhere, and then we'll be flying. Like in January, I'm flying to Amsterdam, and then to Dubai to give some investment talks, and then we'll be flying back to actually Guadalajara, which is where we'll park that van, and then we'll continue south and keeping the adventures going.
Wow, that's amazing. That I'm sure everyone listening to this talk is somewhat jealous.
Anyone could do it. That's the cool thing.
Yeah, I mean, but then again, you paid the price, right? You were willing to pay the price. I mean, not everyone's willing to bike 55 kilometers to work to save money so they can pop it away in their investments.
It's funny. I guess to put this all in perspective too, I grew up as a bike racer, so that wasn't a big deal for me. That was all right. It was pretty big mileage, but at the same time, it kept me fit, and I did kind of enjoy it. And I was doing bike races at the same time, so it kept me fit to enter the odd weekend race and do reasonably well. So that was my thing. It was my passion. But when I think back to it, I didn't give up anything. Like,
Mm.
all right, I was frugal for sure, and I did my share of house sitting. I did my share of living far away from where I was working, so I was riding my bike back and forth to work. But it was an awesome challenge, like a physical challenge. It's kind of like going, oh, I feel so bad for that guy climbing Mount Everest because it's just so physically hard. But it's not like that for that guy. He's
Huh.
having he's having the time of his life, and so is I. So I didn't feel like I sacrificed anything. If anything, where I'm really lucky is I don't have any really strong desires for material items. Um,
Mm.
and I've read all kinds of really interesting studies. And for me, I just happen to be kind of wired that way. Obviously, when I was really young and I was 15 or 16, I think how cool it would be to have all this great stuff. But then as I got older, I I started to I started to realize that just for me personally, stuff didn't give me any kind of value. It
Mm.
didn't it didn't make me any happier. And I've recently read some interesting studies on that, suggesting that people that drive Ferraris get no more driving satisfaction out of them than people that drive Toyotas.
Mm.
It's like a fix, when you first buy the Ferrari and you're driving it around for the first couple of weeks and you're ripping it up and you're feeling like people are looking at you and you're feeling really awesome. But it's like a drug. After a very short period of time, it just becomes another car. A big house just becomes another house. A new stereo
Mm.
just becomes another music system.
Interesting. I love that. I love that real talk right there. It's yeah, no, I read many studies on happiness that somewhat say the same thing, and it's I mean, yes, money does make a difference, but only up until a certain point,
Yeah.
and yeah, they do say, yeah, someone who's making, let's just say, 300,000 isn't necessarily much happier than someone who's making, let's just say 100,000. I mean, yeah, it's a lot of money, but I mean, even though that $200,000 gap is quite significant, they're they're necessary. They aren't necessarily uh, much significantly happier, right? So
Yeah, it seems like there's like in the US they talk about a $70,000 threshold, and above that point there's really no added level of contentment with the more income that's earned. But the one thing that if you can become financially literate and then financially free, you buy choice, and so you buy choice to pursue happiness and true happiness. So true happiness is time spent with people that you love. And so my wife and I probably spend more time together than any married couple, or as much time as any married couple in the world, and we love it. So we can afford to spend this time together doing these amazing things and traveling around the world together, and spending time with people, just sitting down and just chewing the fat and, and learning about people and cultures. And these are the kinds of things that really fuel us, and they fuel all of us. They fuel us as a society far more so than stuff does. It's time spent with people.
mm,
That's what fuels us. Time spent with people we love. Time spent with communities, and following fun, outdoor type passions.
yeah, no, I agree with you 100%. Absolutely, it's the choice, the freedom to spend with your loved ones, the ones who you actually want to be around. That's probably going to matter more than having a nice car or having this nice designer bag or yeah. But
Yeah,
agree.
yeah. It's interesting. You look at those studies on people that have, they've been on their deathbeds, and they've asked them, "What do you regret?" And no one ever says, like, "I wish I got that raise back in 2035." You know.
Yeah, no, I agree. So as we're just kind of finishing up, what's in the works for yourself? Are you going to write another book, or will you be doing more speaking engagements? Yeah. So what's in the works for yourself?
Well, I just finished revamping my expat book, and
Okay.
so the title, "The Global Expatriate's Guide to Investing," was a very forgettable title. It was easy to forget. What you wrote, "Millionaire Teacher and something global blah blah blah." Yeah, yeah. So chatting with the publisher, we decided to put out a second edition, and it has a really simple title. It's just "Millionaire Expat: How to Build Wealth Living Overseas."
Hmm.
So
Okay.
it's paperback. I'm in the very final stages of the editing for that book, which comes out in January. So I'm pretty excited about that book because it's about a 40% revamp from the
Wow.
Global Expatriates Guide. So it's quite a significant second edition. I don't want to be one of those writers who produces a second edition and people go, "Wow, but there's nothing new in here." I love books like that. It's like, really? There's like one new chapter? So I want to take a really good run at it and give it a really good, honest effort. And I'm excited about it because I know that as a tool, at least I hope that as a tool that can change people's lives.
Hmm. Yeah, I'm guessing that's the most satisfying part of writing.
Yeah, it is satisfying, that and the speaking, especially speaking to British expatriates,
Hmm.
which sounds kind of like, "Hi, why would he be so excited about speaking to British expatriates?" Well, let me tell you this, Ryan. Nobody in the world gets more ripped off than British expatriates.
Oh, no way. I
Oh, it's absolutely horrific. So in the Global Expats book that you read, you probably read about some really horrific financial products, right?
Yeah, yeah.
Yeah. And I think I titled that chapter "Don't Climb into Bed with a Silver-Tongued Player," um, and and it's usually British people selling absolutely horrific financial products to British people. So I love going and talking to big, massive British audiences, and they know they've been ripped off, but it's great giving them some kind of alternative.
Okay. All right. Well, no, that's good. I always thought Canadians were kind of getting ripped off compared to Americans, but there's always, I guess,
Yeah,
someone else who's in a worse position than you are. So,
British expats. Yeah,
yeah.
British. Yeah.
Um,
So Canadians pay the second highest
mhm.
fees in the world, and British expats pay the highest.
Yeah. Well, that's I guess I'm kind of fortunate in that sense. Okay. So, well, lastly, where can people find or connect with you?
Well, I have a blog at andrewhallam.com, and then there's a Millionaire Teacher Facebook page as well. If you're an expatriate, there's an expat international teachers and expatriate financial advice Facebook post or Facebook group as well. And so, yeah, I guess I'm easily accessible. Maybe I'm too easily accessible, Ryan.
Okay, so for everyone who's watching, I'll be sure to leave the links below on where you can join these groups or contact Andrew or even check out his books if you're interested. But yeah, thank you, Andrew, for taking the time to be here today, and I really enjoyed the time that you. Yeah, I really enjoyed this time or this interview with you.
Yeah, I enjoyed the chat, Ryan. Thank you.
Yeah. All right. Well, thank you very much.
Thank you.